Something is happening in the silver market right now that most investors are not prepared for. A quiet shift, a pattern that has only appeared a handful of times in the last century, and every time it has appeared before, it has preceded a moment of financial history. Right now, behind the scenes, the numbers are moving in a way that few are watching closely enough to notice. By the end of this video, the picture will be impossible to ignore. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand the forces shaping the economy before they become headlines, not after. If this is your first time here, consider joining the community. It costs nothing, takes a moment, and ensures this kind of analysis reaches you first. And before moving forward, where is this video finding you today? Drop your city or country in the comments. It is always worth seeing just how far this conversation travels. Early on a quiet trading morning, something unusual happened in the silver market. The price moved sharply within minutes. For most people watching the news, it looked like just another swing in a volatile market. But for those who study these markets closely, it looked like something else entirely. A signal. Silver had been trading in a narrow range for weeks. Nothing dramatic, nothing that made headlines. Then, without warning, the price jumped. Minutes later, it dropped just as fast. To an untrained eye, this looked like noise. To an experienced analyst, it looked like a message. Markets rarely move this way without a reason. Sudden price swings, especially ones that happen during quiet hours, often point to large trades being placed by big financial institutions. These are not ordinary investors buying a few ounces of silver for their savings. These are large funds, banks and trading desks moving significant amounts of money. And when they move, they tend to move for a reason. To understand what is really happening, it helps to look beyond the price itself and focus on something called open interest. This is simply the total number of active contracts in the market at any given time. When open interest rises, it usually means new money is entering the market. When it falls, it often means traders are stepping back, unsure of what comes next. For months, open interest in silver had been falling. Fewer players were engaged, confidence was low, prices had drifted downward, and interest in the metal seemed to fade. Many assumed silver had lost its shine, at least for the time being. But recently, this pattern started to shift. Open interest began climbing again, slowly at first, then with more speed. This kind of change rarely happens without a reason. When large amounts of capital start flowing back into a market that had been ignored, it usually signals one of two things. Either something has changed in how investors see the future, or someone with more information than the average person is preparing for a move before it becomes obvious to everyone else. Neither explanation is something a careful investor can afford to overlook. This is where the story becomes more than just a chart pattern. It becomes a question about timing. Big financial players rarely announce their intentions in advance. They do not send out press releases before making major moves. Instead, they act quietly, building positions before the rest of the market catches on. By the time ordinary investors notice, the opportunity to act early has often already passed. This is not a new pattern. It has happened before, in different markets at different times. A quiet buildup, followed by a sudden shift in public attention, followed by a much larger price movement. The early stage is always the hardest to notice because, on the surface, nothing dramatic seems to be happening. Prices may even look flat or unremarkable, but underneath, the structure of the market is changing. What makes this moment different is the speed at which this shift is now happening. The recent jump in trading activity was not small. The volume, seen in just a few minutes, was far higher than what is normally expected during quiet hours. This kind of activity does not happen by accident. It happens when serious money starts to move with purpose. For business professionals and long-term thinkers, this is the kind of detail that matters far more than the daily headlines. Headlines often focus on short-term price changes, up one day, down the next. But real understanding comes from looking at what is happening beneath those numbers. It comes from asking why large institutions might be repositioning now while public attention is still focused elsewhere. There is no way to know with certainty what these large players know or expect. Markets are complex, and no single data point tells the whole story. But when several unusual signals appear together, quiet accumulation, rising open interest, and sudden bursts of trading volume, it becomes difficult to dismiss them as coincidence. What this means for the months ahead is still unfolding. But one thing is becoming clear. Something is shifting beneath the surface of the silver market, and it is happening quietly before most people are paying attention. To understand why this matters so much right now, it helps to look back at history. Because this is not the first time markets have shown these exact warning signs before a major shift took place. History does not repeat itself in exact detail, but it often follows familiar patterns. And for those who study precious metals closely, one particular pattern from the past is starting to look very familiar again. Decades ago, the world faced a very different kind of crisis. Oil prices surged suddenly, driven by conflict and disruption in major producing regions. At first, this caused fear across financial markets. Investors worried, uncertainty spread, and strangely, the price of gold and silver actually fell in the short term. This confused many people at the time. Logic suggested that rising oil prices, paired with global uncertainty, should have pushed precious metals higher, not lower. But then, something changed. As oil prices continued to climb, inflation began to rise across the broader economy. The cost of everyday goods increased, currencies started to lose purchasing power, and slowly, investors began to understand what was really happening. Rising oil prices were not just a temporary shock. They were the beginning of a much longer, more serious economic shift. Once that realization set in, the relationship between oil and precious metals reversed. Gold and silver, which had briefly fallen, suddenly began rising and rising fast. In just a matter of months, the price of gold nearly doubled. Silver moved even more dramatically, climbing from just a few dollars an ounce to ling levels that seemed unimaginable at the start of the decade. This shift did not happen because of hype or emotion. It happened because investors recognized a basic economic truth. When the cost of energy rises, it eventually pushes up the cost of nearly everything else. And when the value of money weakens due to inflation, people naturally look for ways to protect their wealth. Throughout history, gold and silver have served as one of the most trusted tools for that protection. What makes this historical pattern so important today is how closely current conditions resemble it. Once again, conflict and disruption have caused sudden moves in the oil market. Once again, in the short term, gold and silver initially moved downward instead of upward, confusing many observers. And once again, many are asking the same question people asked decades ago. Why are precious metals not responding the way logic suggests they should? The answer, based on history, may simply be timing. In the earlier period, the shift from falling metals to rising metals did not happen instantly. There was a delay, a period where the old relationship between oil and gold seemed broken. But that delay did not last. Once inflation pressure became impossible to ignore, the market corrected itself, and it corrected quickly. Some analysts believe the same kind of delay may be happening again right now. Interest rates remain elevated, keeping short-term pressure on precious metals. But rising energy costs tend to filter into the broader economy over time, not immediately. Businesses face higher transportation and production costs. Consumers pay more for fuel, goods, and services. Slowly, these pressures build until inflation becomes difficult to control through interest rates alone. If history offers any guidance, this is often the exact moment when investor psychology shifts. People stop asking why prices are not moving and start asking how much higher they might go. That shift in thinking, more than any single economic report, tends to be what drives the fastest and most dramatic price movements in gold and silver. There is one more detail worth noting from the historical record. During the earlier period, mining companies that produced gold and silver did not see their stock prices rise as quickly as the metals themselves. This created what many experienced investors call a lag, a gap between the value of the metal and the value of the companies that produce it. Some analysts today believe a similar lag may be forming once again, suggesting that certain parts of this market may not yet reflect what is beginning to unfold. None of this guarantees that history will repeat exactly as it did before. Every economic period has its own unique conditions, challenges, and outcomes, but patterns like this rarely appear by accident. When the same warning signs, falling metals during rising oil prices, delayed inflation pressure, and undervalued mining shares, show up again decades later, it becomes difficult to view them as pure coincidence. To understand how much stronger these forces are becoming today, it becomes necessary to widen the lens beyond history alone and examine what is happening on a much larger global scale. While traders and analysts study charts and short-term price swings, a much larger and slower story has been unfolding in the background. This story does not involve daily headlines or dramatic price jumps. Instead, it involves entire nations quietly changing how they choose to hold their wealth. For many decades, most countries kept the majority of their financial reserves in paper assets, particularly in the currency of major economic powers. This approach made sense during periods of stability. Paper reserves were easy to manage, easy to trade, and widely trusted across the global financial system. But trust, once shaken, is difficult to rebuild. And in recent years, that trust has been tested in ways many did not expect. One of the clearest signs of this shift can be seen in how central banks around the world have been behaving. Rather than reducing their gold holdings during periods when prices fell, several major central banks did the opposite. They increased their purchases. This behavior stands in sharp contrast to how ordinary investors often react. Most individual investors tend to sell when prices drop, hoping to avoid further losses. Central banks, especially those managing national reserves, often think differently. They see falling prices not as a warning sign, but as an opportunity to acquire more of an asset they already view as essential. This pattern has become especially visible in nations seeking greater independence from traditional financial systems. Some of the world's largest economies have steadily added to their gold reserves month after month, even during periods when public attention was focused elsewhere. Import records, customs data, and central bank reports have quietly confirmed this trend. even without dramatic announcements or press conferences. This is not simply about gold either. Silver, often viewed as gold's smaller counterpart, has started to show similar signs of strategic importance. In certain regions, demand for physical silver has grown so strong that buyers have been willing to pay a noticeable premium above standard global pricing just to secure supply. This kind of premium does not usually appear during periods of weak demand. It appears when local buyers value physical possession of the metal more than the paper price quoted on international exchanges. This growing preference for physical assets reflects a deeper shift in thinking. Currencies, no matter how widely used, are ultimately promises backed by governments and institutions. Gold and silver, by comparison, carry no such promise. Their value does not depend on the stability of any single country or political system. This quality becomes especially important during periods of uncertainty, when trust in traditional financial promises begins to weaken. There is another layer to this story that deserves attention. In recent conversations among policymakers and financial officials, there has been growing discussion about using precious metals, particularly silver, as a form of collateral within larger financial systems. This idea may sound technical, but its meaning is simple. When a government or financial institution begins treating an asset as collateral rather than just a commodity, it signals that the asset is being viewed as a foundation of value, not merely something to be bought and sold for profit. This shift carries significant implications. If more institutions begin treating silver as a strategic financial asset rather than an industrial material, the demand for physical silver could increase in ways that go far beyond traditional investment buying. At the same time, this growing institutional interest raises important questions about access and control, questions that thoughtful investors should continue to watch closely as this trend develops. What makes this global repositioning so significant is its pace. This is not a sudden, isolated event. It is a steady, ongoing pattern that has been building for years, largely outside the attention of everyday headlines. Nations do not typically make dramatic announcements when shifting reserve strategy. Instead, these changes happen gradually, through consistent purchasing, quiet policy discussions, and long-term planning that unfolds over years rather than days. For business professionals and serious long-term investors, this slower, more deliberate pattern often carries more weight than short-term price volatility. Daily price swings capture attention, but they rarely reveal the full picture. The real story lies in what large institutions and governments are doing with their long-term reserves, decisions that are made carefully, deliberately, and often far from public view. As this global shift continues to build, it raises an important question. If confidence in traditional financial promises continues to weaken, what happens to the broader financial system that depends on that confidence to function smoothly? To answer that question, it becomes necessary to look inward at the structural pressures building within the financial system itself. Behind every market movement, there is a deeper story about the health of the financial system itself. And when that system shows signs of strain, precious metals often become one of the clearest places where the pressure eventually surfaces. One of the most important warning signs today comes from long-term government bonds, particularly those issued over 20 or 30 years. For a long time, these bonds were viewed as one of the safest investments available. Banks, pension funds, and insurance companies purchased them in massive quantities, especially during periods when interest rates were extremely low. At the time, this seemed like a reasonable, cautious decision. But conditions have changed. As interest rates rose sharply in recent years, the value of these older, lower-paying bonds fell. In some cases, bonds that were once worth close to their full original value are now worth significantly less if sold today. This creates a serious problem for the institutions holding them. On paper, many of these organizations are sitting on large, unrealized losses. As long as they do not sell these bonds, they can avoid officially recognizing that loss. But this arrangement only works if they are never forced to sell. That is where the real danger lies. If a financial institution suddenly needs cash, whether due to a crisis, a rush of withdrawals, or unexpected losses elsewhere, it may be forced to sell these bonds at a steep loss. This is not a hypothetical scenario. It has already happened before, and when it happens on a large enough scale, it can quickly turn a quiet, hidden problem into a very public one. At the same time, ordinary households are showing their own signs of financial strain. Personal savings rates have fallen sharply, reaching levels not seen in years. This means fewer people have a financial cushion to fall back on if unexpected expenses arise. Consumer confidence has also been declining steadily, and this decline is not limited to one age group or income level. It is spreading across generations, from older, more experienced savers to younger workers just beginning their careers. This matters because consumer spending drives a large portion of overall economic activity. When confidence falls and savings shrink at the same time, it creates a fragile foundation, one that can be disrupted more easily by even modest economic shocks. Businesses depend on steady consumer demand. When that demand weakens, the effects tend to spread across the broader economy. All of these pressures point toward the same underlying issue: debt. Total debt levels across governments, businesses, and households remain extremely high relative to the size of the overall economy. High debt is manageable when interest rates are low and growth is steady. It becomes far more dangerous when rates rise and growth slows at the same time, a combination that limits the options available to policymakers. Historically, when governments and financial systems face this kind of pressure, there tends to be only one realistic path forward: expanding the money supply to ease the burden of that debt. This approach can provide short-term relief, but it often comes at a longer-term cost, a gradual weakening of currency value over time. And when currency value weakens, investors have historically turned toward assets that are not tied to any single government's promises, assets like gold and silver. This is where the earlier parts of the story begin to connect. The unusual trading activity in silver, the historical pattern linking oil, inflation, and precious metals, the steady global shift toward gold and physical assets, and now the visible strain building within the financial system itself. None of these signals exist in isolation. Together, they form a much larger picture, one that suggests the conditions now taking shape may not simply fade away quietly. What happens next depends on how these pressures continue to build and how quickly the broader public begins to notice what analysts and institutions have already started preparing for.